Hello everyone, this is Phil Yaeger and welcome to Selected Financial Statement Accounts. And we're going to do letter C, inventory, on page 2C1. Now, inventory are goods that a company resells. Remember that, all right? They can be manufactured or they can be bought from someone else, but they intend to resell those goods. Now, the first blueprint on page 2C1 says calculate the carrying amount of inventory and prepare journal entries using various costing methods. All right, now, the initial measurement is this. Inventory is initially measured at cost, all right, which is the price paid, all right, or the consideration given up to acquire the asset. Now, we include product costs in the cost of the inventory. And these would include import duties, freight in, that's part of the cost of the inventory, storage, insurance, and in the case of wine and cheese, all right, because a lot of you want to know about wine and cheese, the ordinary cost of aging for selling, all right, that's part of the cost. Now, the formula, all right, to determine the cost of goods sold is this, all right. You take the beginning inventory plus the cost of the goods purchased, all right, and that gives you the cost of goods available for sale. Now, what do? You subtract the ending inventory, and that gives you cost of goods sold. Now, normally, this is the calculation on the income statement for the periodic method of inventory. And the periodic method says this: we will certainly keep track of what we purchase, but in order to determine our cost of goods sold, we have to count our ending inventory, all right? And only in the periodic method do we show a cost of goods sold section, as basically is shown here. Now, it says here, all right, this is the calculation of cost of goods purchased. You take your gross purchases minus purchase discounts minus purchase returns and allowances, and don't forget to add in freight in and transportation in to get the cost of goods purchased. And by the way, that's the way it will be shown on the actual income statement under the periodic method. You wouldn't just show cost of goods purchased, you would show, all right, gross purchase, less discounts, less returns and allowances, and then you would add in freight in, only freight in, because freight out is a selling expense. All right, now, it says on the top of page 2C2 that while many product costs are capitalized, some incidental and indirect costs are not. All right, for example, selling and administrative expenses, all right, are actually expensed. All right, and these are called period costs. All right, and also immaterial or insignificant product costs can be expensed if the cost of the accounting for the expenditure exceeds the benefit. This is acceptable under U.S. GAAP as long as the technique is consistently applied. Now, be clear what to include or exclude freight costs in inventory. All right, freight in, freight out. All right, now, freight in is part of the cost of the goods purchased. Freight out is a period cost. It's excluded from inventory because it is an expense. All right, now, there are two methods of recording inventory. They are the periodic method and the perpetual method. All right, now, the perpetual method, all right, and that's the method we'll show first. The perpetual method is where you keep track of everything you purchase and you're able to keep track of what you sell. And normally, that is a method that's used in most retail stores, because once a sale is actually rung up on the register, all right, it also takes the inventory out, the cost of that inventory, all right, so that at any time you know your cost of sales, all right, for all your products during the month. All right, now, the thing to remember is under the perpetual method, when you record inventory, all right, the purchase of inventory, it goes directly to the inventory account. All right, so if they purchase $400,000 of inventory, as it says in the middle of page 2C2, all right, you will debit inventory, credit accounts payable. All right, that's the perpetual method. Now, they sold all of the inventory for $500,000. All right, now, when you have the sale, you debit accounts receivable, credit sales, and then because it's the perpetual method, every time when it's sold, we keep track of it, and we can credit the inventory for the $400,000, and we can debit cost of goods sold. So notice, in the perpetual method, we actually have a cost of goods sold account. So you don't have to do a cost of goods sold section as you do in the periodic. All right, now in the periodic system, please remember, you're keeping track of what you purchase, but if you want to get your cost of goods sold, you have to do a cost of goods sold section in the income statement, which means you have to count your ending inventory. So let's see the difference here. Now we purchase inventory under the periodic, and we sell $500,000. All right, now instead of debiting inventory, we debit purchases for the periodic method and credit accounts payable. And then we go to the top of page 2C3, all right, and we debit accounts receivable, credit sales, all right, when we sell it. Now under the periodic, remember, all right, we do not keep track of what is sold. So we can't record any cost of goods sold, all right? We can't debit cost of goods sold, all right, and credit inventory or credit purchases, all right? So what you have to do is, all right, when you actually prepare your income statement to get your cost of goods sold, you're going to have to do a cost of goods sold section of the income statement by taking the beginning inventory plus the cost of goods purchased. You always know what you purchase. And now we give you the goods available for sale. And then you have to count your ending inventory, subtract it from goods available for sale, and now we'll give you cost of goods sold. All right? Now, there's a hint box here. Even in a perpetual system, if there's theft, loss, damage, and human error, requires the performance of a periodic physical count to verify the inventory level recorded in the firm's accounting system. Some firms do this one time a year at fiscal year, all right? Others do a component every month or every quarter to smooth the additional workflow required over the calendar year, all right? Now, if a difference exists between a physical count and the perpetual inventory system, the discrepancy is typically recorded with an adjusting entry to inventory and an income statement account called inventory over and short, all right? Now, what that will do is this. If you have a perpetual inventory system, okay, and, all right, it shows this came in, this went out. Now, if there's any thefts, your perpetual inventory system is not going to show in the register thefts, because if a thief steals something, he's not going to come over to the register and say, hey, I'm going to steal the inventory, so I want you to debit an expense for the theft and credit the inventory. They're not going to do that, all right? So there's always going to be a difference between your physical count and what's in the perpetual inventory system, and this could be due to theft, loss, damage, all right? So if there's a difference, for example, all right, assume the perpetual shows the ending inventory is overstated by 400 compared to the physical count, and you do some investigation, and you find out it's attributable to shrinkage, all right, which requires the company to write down the inventory. You debit the account inventory over and short 400 and credit inventory. Now, periodic inventory systems do not have a separate record of expected ending inventory. So the concept of writing down inventory as a result of the end of month reconciliation is not applicable. The cost of goods sold will already include the shortages or overages that would have been determined in the ending inventory count of a perpetual system. So this entry, debit inventory over and short, credit inventory, is only for perpetual inventory. All right, now, the next thing on the bottom of page 2C3 wants to know what goods are included in inventory. All right, well, merchandise inventory includes all inventory owned and held for sale, all right, but special attention must be required for goods in transit, goods that are held on consignment, and goods that have been damaged and or obsolete. Now, let's take the first thing. All right, remember, your inventory includes all goods that you have title to, whether you have possession or not. The key thing is having title to. All right, so what we do to determine goods in transit is we look at shipping terms, FOB, shipping point, or FOB, destination. Now, in FOB shipping point, the seller ships the goods, all right? So when the seller ships the goods, title passes to the buyer, and these goods must be included in the buyer's inventory. But FOB destination, title does not pass until it reaches the buyer, all right? So therefore, the goods in transit are not in the inventory of the buyer while in transit, all right? Now, also, all right, consigned goods. Now, please remember, if I consign goods to you, I am asking you to sell my goods as an agent, and I'll give you a commission. All right? But remember, the consignor who consigns the goods to the consignee, all right, just transfers possession of the goods to the consignee, but not title. So consigned goods are always in the inventory of the consignor, all right? And we'll talk about goods that have been damaged or obsolete, all right? So on the bottom, I talk about FOB shipping point, all right, and FOB destination, all right, which is on the top of page 2C4. Just discussed that. Now, please note, on top of page 2C4, if they only use the term FOB, now that's not a dirty thing, all right, to say, hey, you're an FOB, all right? FOB by itself means FOB shipping point, all right? Now, we also, all right, number 2, we already discussed consignment. Remember, consignment is where the consignor remains to have title to the inventory, all right? The consignee does not have the inventory as an account in their books, okay? All right, now, it says here, right before example of consignment, a consignor who consigns goods to a consignee transfers possession but not ownership of the goods to the consignee. So the inventory stays in the consignor's books. All right, now on the bottom of page 2C4, there's an example of consignment. Sadie consigned inventory on November 15, 2006 to Seymour. The consignment was for 35 ovens at a selling price of $2,000 per oven. That better be a very good oven for $2,000. All right. Sadie agreed to a commission of 15% to be paid to Seymour upon the sale of the ovens. Sadie also agreed to pay $1,000 in shipping costs to get the goods to Seymour. On December 31st, 2006, Seymour sold 10 of the 35 ovens and remitted $20,000 to Sadie, less Seymour's commission of 15%. The journal entries to record these transactions on the consignor's books. All right. Well, all right. Seymour sold 10 ovens at $20,000. That's the total amount. It's not $20,000 an oven. So the total amount is $20,000. So notice we're going to credit on the consignor's books consignment sales for $20,000. That's the revenue on the consignor's books. All right. Now, please note it is Seymour who has the what? The money. All right. So therefore, Sadie, the consignor, is owed $20,000 less the commission. All right. So therefore, the amount that Sadie is owed is $17,000. So Sadie, the consignor, will debit accounts receivable and debit commission expense. All right. Now, when the goods are sold, all right, this is what will happen. All right. First of all right, there's going to be a debit to cash to record the receipt of the cash from the consignment sale. Debit cash, credit accounts receivable. That's when Seymour, all right, sends the money to Sadie. And then on the top of page 2C5, all right, we're going to have the consignee's books. All right. Now the consignee, who is Seymour, all right, is going to do this. At the time of the sale, he's going to debit cash for 20. All right. He's going to record his commissions earned of 3, and he owes $17,000, the net amount, to Sadie. All right. Seymour writes the check. He will debit accounts payable, credit cash. Now it says here, number 3 on page 2C5. It says damaged or obsolete or spoiled goods are excluded from inventory for sale, but must be monitored to examine and manage these amounts, which should not be material or significant. Damaged goods such as spoilage must be valued at net realizable value, which is defined as sales price minus cost to dispose of the goods. The cost of disposition can be an estimate. The reduction of value is accounted for as a loss and is recorded or matched to the period when the loss value occurs. All right? Are we out of time? We certainly are. All right? So that's going to end our first class on inventories, and we'll come back and we'll do some multiple choice on this area, and that should explain it. So anyway, thank you, everyone. The first class on inventory is over.